All right, good Thursday afternoon. The Thursday afternoon before Good Friday and Easter weekend. Happy holidays for those of you who are celebrating Easter weekend, and for those of you who celebrate Passover, of course. Welcome back to Finom Group's weekly State of the Market. As usual, I'm your host, Seth Golden, and my co-host, the illustrious Brad Carter. We're going to jump into a lot here today before the extended weekend. For our Phenom Group members, heads up, we don't have a weekend research report this weekend due to the holidays. Pick things up again next weekend. So we kind of have a bit of an extended state of the market, a lot of information, a lot of charts, a lot of studies to go through here today. Markets are trying to rebound here today from successive daily losses. We'll see where they end the session. And don't forget also, big data point tomorrow, while the markets are closed for Good Friday, we do have the non-farm payroll report at 8:30 a.m. CNBC special coverage of the data. So enjoy the holidays, but I'm sure investors, traders alike are going to be glued to that piece of economic data when it comes out. Freshly squeezed tomorrow morning, 8:30 a.m. Eastern time. So before we actually dive into our weekly content here, I kind of wanted to briefly discuss what's going on with the banking sector. I know that we've hinted at it, probed around that conversation in previous state of the markets. But I also realize that it's still the hot button topic of concern going into the second quarter here, the month of April. The headlines haven't really abated, and a lot of the economic data that came out this week seems to have softened. But what I would stress or emphasize is that much of the data that we got out this week was soft data. When I say soft data, I'm characterizing it or distinguishing it between with hard data. Soft data we often refer to as surveys, ISM manufacturing, S&P manufacturing PMI, as well as ISM and S&P, a lot of acronyms we got going on here, service sector PMI data. Those are surveys. They're soft data. Both institutions gave their data for the month of March, and they stunk. Services and manufacturing both edged lower here during the month of March. While the service sector remains in expansion territory, the manufacturing sector keeps getting worse. In fact, the ISM manufacturing index fell to a new low for the current cycle at 46.3. And that's contraction territory. Usually recessions are associated, with a ISM manufacturing index at that level. But you could have said that 6 months ago. We've been in contraction territory or manufacturing recession since November, roughly 6 months ago. So I kind of want to highlight or headline that fact, because for all the people that have said the economy's slowing, look at manufacturing, well, that's 6 months in the works, folks. And yet still don't have a recession. Don't get me wrong. We'd rather see a manufacturing rebound. But, for the recessionistas that keep banging on that drum, we're 6 months into this, and it's starting to actually feel like 2015, 2016, when we had a manufacturing contraction. What's the line in the sand for those of you not familiar with differentiating a manufacturing contraction and a manufacturing expansion? 50. Anything below 50 is a contraction. Any reading above 50 is expansion. So just some of the data, that has been proliferating this week, but largely the data that's been that has been weak, I should say, or weaker, has been the soft data, the surveys from ISM and S&P. Going back to my original point of emphasis on the banking sector, we know that banking standards are tightening, banking lending standards are tightening. We know that there's probably going to be some degree of Loan weakening, not necessarily on the demand side of the equation, but you might see less loan offerings, more stringent standards, just a natural evolution of the credit cycle. And people are worried about that because usually these types of contractions in credit are also recessionary warnings, if you will. So the first chart I actually want to go to is this one right here. And you may have seen this. It's very popular right now, whether it's the financial media or the social media. This is the net percentage of domestic banks tightening standards for commercial and industrial loans to large and middle market firms, right? So tightening standards, right? That doesn't sound good. And the number, right? The percentage, I should say, the percentage of banks tightening standards is like rocketing higher. Keep in mind, this started in 2021, folks. Q3 2021 is where this particular metric troughed. And ever since then, it's been going higher. So more and more banks have been tightening credit standards up here into the Q1 period, right? And this looks bad. Just the way I have this chart represented looks bad. It looks like, oh my gosh, every time we see something like this, here's a recession, here's a recession. Well, we know this is COVID, right? So we kind of step over that, but either way, we are getting into these levels where they're usually associated with recessions. Now watch what I'm going to do here, because this is the most popular chart. It's indexed to the percent level, the percentage of banks which are tightening credit standards. So I'm going to go to the edit graph button here at the St. Louis Fed, and I'm going to change the units on this from percent to change from a year ago. So we're going to look at it on a year-over-year basis by percent. And now look what happens to the chart. But again, we've been tightening credit standards for quite a while, but basically since Q3 of last year, credit standards haven't really tightened that much. They've actually flattened out. Amazing what happens when you change the setting, right? Because what really matters is year over year. Not the percent of total banks that are, it's the percent total on a year over year basis. Are we seeing credit standards tightening at an accelerating pace, at a decelerating pace, or pretty much just flattening out? Fun with charts, as I like to say. This won't get a lot of attention, on Twitter or in Facebook groups, but this one will. This gets a lot of attention, a lot of fanfare. What do you think about the whole situation, around banking right now, and the concerns, the fears that we hear in the financial media in that respect, Brad?
Well, yeah, standards are tightening, as you said, and they have been for a while. But we don't want to oversell this idea that it's hard for legitimate companies to get money. That's a whole other question.
Right.
Sometimes an increase in standard can mean another piece of paper you got to sign. So you have to be real careful about this. If you think about it, getting a mortgage now compared to what it was pre-2008, oh my gosh, when you go to closing, there's a million things you have to
it's horrible. It's like the Bible of, home closing documents. So
the problem for us in the market is it makes a great headline, and it produces the same old clickbait for MSNBC and so forth. And come see this spooky headline. There were getting off the subject. There was a spooky headline this morning that is something important to think about, but it wouldn't drive me out of the market. And one of these big short sellers was talking about fallout from the climate crisis. What about these areas that could flood, real bad?
Right.
Florida, for example, your neck of the woods. And
Thanks for reminding me.
so I think the message for us is that stuff's always out there
Right.
every
Right.
day.
Yeah, this is what you live with. Yeah, you
And
live
and
if you live
and
in the
what
US economy.
and what all we need to do is stick with our game plan.
Mhm.
That's all that matters.
Yeah, yeah, totally agree. I remember because you mentioned you might have to sign one more document to close that loan or to close on a house or what have you. I had, my first marriage unfortunately failed. I was very young. But during our divorce, I bought another home. And in order to close on that home, I had to get my soon to be ex-wife sign off on the deed. That was one more piece of paper because this was 2010, right? Just, shortly after the bottom in 2009 and things, were trying to get going, but the housing recovery really didn't start until 2011. So speaking of that one more document, I was at the closing, Brad, and this is in um, Naples, Florida. My original home, our marital estate, was in Pembroke Pines, Florida. I'm at the closing in Naples, which is about an hour and 45 minutes from our Pembroke Pines home. And they say, is your wife here? My wife and I have been separated for about 9 months. What are you talking about? Like, but you had marked that you're married. I am still married, but we're going through a divorce. She will need to sign off on this. I'm like, are you kidding me? I literally, in order to close that day, I had to call her. I called her and I'm like, well, I'm really sorry. I need to close on a house. And they're telling me that, because we're not divorced yet, you do have to sign off. And she's like, okay, I'm in Miami right now. And I was like, it'll take me like an hour and 45 minutes to drive down there. Can you meet me? And she's like, yeah, sure. I drove an hour and 45 minutes to Miami, an hour and 45 minutes back to Naples for the closing that day because credit standards were tighter back then. I mean, the banks, are under, these new stress tests, rules and regulations. And, that's just a anecdotal experience that I went through. But I think that's really all we're talking about when we see the chart of, percent of banks that are tightening credit standards. It may just be an additional document. You may need one more point on your credit score or two more points on your credit score. And maybe you have to wait another week, 2 weeks, to get that boost in you. But that's probably all we're talking about here. But to your point, the media blows this out of proportion as if, they're tightening lending standards. That must mean everybody's out of a job and the economy goes into the crapper. So it's nutty out there. You gotta keep your head and think about these things rationally. And of course, tune into the State of the Market week in and week out. All right. So speaking of rationally, look what's going on with the price of gold. And this was a great quote that I had found from David Tepper. David Tepper was once asked about his thoughts on gold and whether or not it has a place in the average investor's portfolio. And he answered the question. He says, the markets rarely are what we want them to be and are what we rarely want. It's supposed to feel uncomfortable. What's the only logical conclusion from this? If you're investing in gold, you're not an investor. There's few investing vehicles where one can literally yawn and say, hold my beer, like gold can. Because, basically the point he's trying to get, there's no real volatility in gold. You buy some because you've decided in your head, this 10% of my retirement portfolio, I'm just going to own gold for this 10%. And in 20, 30 years, it's going to be higher. I mean, that's how gold works. But it just, if you compare it to the S&P over any 5 and 10-year period, it's going to look bad. You're going to wish. There's the opportunity risk that you can't calculate for gold because you know you're going to underperform. So there's no volatility there. Nobody cares. You 10%, you don't worry about it. So, David Tepper, which, he's saying much of what I've felt for many years. If you're in gold, you're not an investor. So I just like how he says, yawn, hold my beer. Nothing else in the there's not many investment vehicles out there that you can actually say, yawn, hold my beer. So good stuff from David Tepper there of Appaloosa Portfolio. In this past weekend's research report, we talked about April. What's the historical performance around April, and it's pretty darn good. This goes back to 1950, folks. This chart here from Carson Investment Research, 94% probability going back to 1950, April is a positive month. The average return since 1950 has been 3.5%. The only better return on a monthly basis has been January at 4.1%. Is this April going to be one of those years where we do, see the S&P 500 give a positive return? Almost a 95% probability. I kind of like our odds. But what else if we kind of narrow down criteria? And here's something else that we know. Last year was a down year. Q1 was positive. When the prior year was a down year, according to Bespoke Investment Group, in the new year, the market had a positive return in Q1. April was positive every single time. We'll see what happens here in 2023. Down year last year, up in Q1 every single time since 1954, the S&P 500 delivered a positive return. And the rest of the year was positive also. Not just positive, but man, there are some big jumps in here. 33%, 31, 23, 13. The worst rest of the year from April, April 30th forward, looks like, 7%. So this is, quantitative study from Bespoke Investment Group based on what just happened. A down year last year and a positive Q1. Good stuff. The yellow, this is the same chart, but in yellow, this highlights the double-digit down years. 14% in the prior calendar year, 11%. Ours was 19.44, which is the second worst since 1975. Something else we talked about, like coming into this week, we had the notion that markets were overbought. I don't think anybody missed those last 2 days of the quarter where I think the NASDAQ was up, like 3.5% in 2 days. The S&P was up more than 2% in those final 2 trading days. And naturally, what happens when you get that kind of burst of energy, you're probably going to experience some overbought conditions. And one of the ways that we can look and distinguish between overbought or oversold conditions is by way of the McClellan oscillator for the various indices. This is the S&P 500's McClellan oscillator, and as you can see, I mean, over 100 here, folks. We did that once there in October, and we did that basically towards the middle of May last year. And these are very oversold conditions that are ripe for some kind of consolidation. Consolidation can come in 2 forms, at least. The indices can consolidate for time, or they can consolidate for actual price. They can do both as well. But this is the S&P 500 McClellan oscillator, and it was an extremely overbought territory. Same thing for the NYMO or the NYSE McClellan oscillator, overbought territory. And so what happened this week? We've had some price consolidation. We do these, we look under the surface of the market. We look at breadth. We're looking at technical patterns, formations. We're looking for resistance. We're looking for support levels. We're looking at how the moving averages are shaping. Are they curling down? Are they curling up? Are they flattening out? How many stocks do we have above the 50-day? How many stocks do we have above the 200-day? We're doing this for all the major averages. It's a lot of work. We're doing it for you. The other thing that also told us, you can stay overbought for longer than most people care to consider, in the same way that we can stay oversold for longer than most people care to consider. But one of the other things that we noted in our weekend research report, not highlighted here in our state of the market, was that the S&P 500 also closed the quarter, the week, and the month above its upper Bollinger Band. And folks, you just don't spend a lot of time up there before you do some degree of consolidation. Again, it's about expectations. If you have the right expectations, and you have a kind of an inkling of what comes next, or in the interim at least, you don't have to worry about the narratives that are being painted by the financial media. Why price is doing what it's doing. Go ahead, Brad.
If I want to throw in that it's understanding this kind of stuff that actually helps people like me and you make money.
Yeah, exactly.
But because the whole idea of trading around a core, for one thing, and also moving from aggressive to defensive and so forth. Like I noticed in my own personal situation, when we had that big run up in growth stocks and stuff and making a lot of money, guess what was coming down? My KO.
Yeah.
So I just wait until it gets down there low enough and I buy some more of that with the money that I've trimmed from other positions.
Fantastic.
Yeah, so that's what you do.
Right. I mean, precisely. I don't have 100% of the Golden Capital portfolio is not growth. I've got Walmart in there. I've got Pepsi in there. I've got Verizon in there. But to your point, and I'm so glad you're highlighting that. Last week we were trimming positions. TQQQ above $27. Trim.
Yep.
Right. And I was adding some to healthcare this week. What's jumped? Healthcare. What jumped? Verizon. What jumped? Consumer staples, Pepsi, Coca-Cola, Walmart. So, having a well-rounded portfolio in all of those names, are blue chips in their particular industries. So trimming growth, and what's pulling back this week? Growth's pulling back now, which again, large cap growth pulling back was the expectation. The other thing I noticed last week is that the S&P 500 advanced decline line was almost back to an all-time high. And while we want good breadth, right? Advanced decline line being at an all-time high, that sounds good, right? You have good breadth. There's, good stuff going on underneath the surface of the market. What I also recognize, because this is the S&P 500 down here, and this is the advanced decline line up here, is that usually when we're making highs in the advanced decline line, this is back in 2018, it's leading to some kind of consolidation. Here we are again up here at the highs, some kind of consolidation. Getting up to new highs, some kind of consolidation, new all-time highs, consolidation, so on and so forth. People always say, well, breadth is good and, it's supporting the market's trend. Yeah, I totally agree. But what can I do with good breadth, right? Do I really? I mean, prices are going higher. Is that what I want to chase? Not really. So, knowing that breadth is good is just part of your, should be part of your daily routine. But ideally, what you're looking for are, breakouts and these overbought conditions, because that's when you need to get prepared, because you're going to have an opportunity to buy the dip. So good breadth good achievements in breadth and breadth thrust. That's great. That helps inform you what to do when we do get the pullbacks, when we do get price consolidation. You should be comfortable and confident that there's been enough muscle memory, to support the trend to date with strong breadth, and it'll be there, to support the market during the consolidation phase. Your opportunity to go out there, buy the dip, more than likely we're going to see higher prices in the future.
Yeah, and the other thing that can throw this off if you're not careful is, stay with, I want to say 90% or better blue chips.
Yes.
And if you're buying something like I did, like you guys know, I've been playing with Papa John's. You can't really call that a blue chip, but it's a quality company.
Yeah.
It's not, it's not some, wildcat oil driller.
Right.
Because if you, and I'm even willing to say it's okay to do some mad money on a speculation as long as you make it a tiny percentage of your.
Yep, totally agree.
You look at my portfolio, the way my account looks over all my balance, you can't tell that I own Papa John's. It's down, but it hadn't affected me really.
Yeah. I mean, I've got a couple of those in my I have Papa John's in my portfolio too, but it's barely even a 1/4 weight position. So yeah, it's down a good $10 from where I bought it, but I don't even think about it. I just wait for the technicals to improve, to show that maybe I can, dollar cost average and get a swing trade, to the upside, and just hold on to that core that I'm trying to build. So yeah. All right, this chart right here, for those of you who have been with Finom Group for a while, you probably recognize this chart or table. This is consolidation years, right? When you have big up years, like 2 years in a row, prior 2-year total returns in this column right here, you're usually going to have a pretty good consolidation year thereafter. And that's what this shows. We had 2 big, strong years, and it led to these consolidation years, 1934, 46. Everybody remembers 2016, 2017 led to a strong consolidation year. And that's what I look, that's how I kind of recognize what we just went through. 2020, the S&P 500 during a pandemic and a global economic shutdown gained 17% for the year. And then 2021, it rose, I think it was 24, 25%. Those are 2 really strong years, folks. So what typically happens after that is you get a consolidation year. But the consolidation year is also an opportunity for investors to compound gains in the future. You can really only do that if you're taking advantage of the consolidation, using that cash that you've had on the sidelines and buying value, buying cheaper prices. This chart right here, and this goes back to, 1962. Market corrections during midterm election years. Midterm election years tend to have corrections, folks. And last year, on a total return basis, 22% downside. The blue, I believe, blue or purple bars to the upside is the year after, or year 3 of a 4-year presidential cycle. So here's the midterm correction. The next year up 33%. Midterm correction in 1966. Year 3, i.e. 1967, market was up 33%. Folks, it's double digits almost every single time. The average is 26% the next year if you've had a correction in the midterm year. In almost every midterm year, you have a correction. Consolidation year, midterm correction year usually leads to significant double-digit gains in year 3 of a 4-year presidential cycle. I just mentioned 1966. Here's the 22% correction. 1967, market was up 33%. This is a layover, and some of you have seen this chart before. It's a great reminder. 1966 through 67 versus 2022 to 2023. And here's where we ended the year. I mean, the pattern is almost, I mean, it's pretty constant. 2022 with 1966. We rallied into the end of the year, bit of a dip here in the end. 1967, up and away. We were up a little over 7% in the first quarter of the year in 2023. So this analog, right, as of now, is playing out perfectly. It's playing out perfectly. Some of the characteristics in 1966-67 time period, the Fed was hiking continuously. Sound familiar? We had raging inflation. Sound familiar? The Vietnam War, Russia-Ukraine war. Sound familiar? Inverted yield curve. Midterm election, all just like 2022. After gaining 6% in Q4 in 1966, stock soared 24% into and through most of 1967. The S&P 500 gained 7% in Q4 of last year, and now 7% in Q1 of 2023. And you know what the earnings growth in 1967? So, you know, people might think, well, earnings must have rebounded to generate this kind of a V-shaped recovery. In 1967, earnings grew 1%. That's it. Just 1%. It's not earnings, folks. That's not the deciding factor here. 1% is not going to give us a 24% return. There's other variables at play. Reminder, our CNBC Markets in Turmoil special, right? This is a study produced by Charlie Bilello. And every time we've gotten a Markets in Turmoil special on CNBC, usually it's a 7 p.m., you know, tune in to find out why the market is performing like crap. It gets people all excited. But the reality is, every time that special has come on 1 year later, the market has been positive every single time. The first occurrence that we had a Market in Turmoil special last year was on May 5th, 2022. The S&P 500 was 4147. We are 1 month away from the anniversary date. So if this is going to stay perfect, and the sample size is robust, people, we've got to be above 4147 on May 5th, 2022. We'll see if it'll happen. I often, talk about the professionals on CNBC, and I don't often characterize them in the best light. Now, do I, Brad? But it's because I don't believe that they are doing their fiduciary duty to the, for their clients. Most hedge funds, and many of you have heard me say this before, they're under leveraged 3 out of the 4 quarters of the year. They have very minimal leverage to the stock market. It helps them to keep drawdowns low, right? Especially if the year is bad and you don't have a lot of leverage, you're not overly exposed to the market, you're probably not going to have a big drawdown. And your clients don't want to see big drawdowns. So it keeps their money in the fund or under your management. Problem is, well, we were up 7% in this first quarter of the year. Current hedge fund asset class positioning. Stocks, 30%. For hedge funds, that was their overall exposure. The historical average, or the long-term average, is right around 50%. So they were under-leveraged in the first quarter on stocks. They were under-leveraged in bonds. They were under-leveraged in credit. It looks like they were equal weight on commodities, cash, and whatever other is, maybe it's cryptocurrencies, I couldn't tell you. Money market funds, probably. Here's current hedge fund equity position. Growth, massively under leveraged. What was the leader in the first quarter of the year? Growth. Emerging markets, under leveraged. And emerging markets had a good first quarter. They actually beat the US. Let's see. Value, under leveraged. Small and medium size stocks, so small and mid cap stocks, they were over leveraged. What was the worst performer during the first quarter, Brad? Small and medium. I mean, talk about the worst positioning. You know, so when you see these people on CNBC, you know why I get so passionate about just how bad their calls are. This is why. This is why. The very thing that they were over leveraged was the laggard of the quarter. You can't make this stuff up, folks. CTA positioning, right? It's all the way down here. What is CTAs? For those of you not familiar, it's commodity trading advisors. And their leverage is basically as low as it's been since 2016. Like, they're not in the market. They're not in the market. And the way I look at this is, look, I get it. There's a lot to be concerned about. There's a lot of unique and unprecedented circumstances in the economy, in the market. I get it. So people are cautious. They're fearful. Take your drawdowns like big boys and girls. You know, if you have cash, you're not getting paid, and you're not going to get some kind of blue ribbon participation award, you know, just by paying attention. You're paid as an investor. You're only going to reap rewards by putting capital at risk. And you know that as an investor. Either you're willing or you're not. It's a different business for the hedge funds, and one theirs is about fee generation. So they're doing their best to not show big declines, big drawdowns. It's a different business. But if you're an active portfolio manager doing it yourself at home, the only way you're going to reap rewards is by putting that capital to work. Don't worry about the drawdowns. You're not competing with other people. It's not capital competition, it's capital appreciation. Keep that in mind, folks. Here's the proportion of active funds outperforming the benchmark. 40% of funds outperform the benchmark in the last 12 months. So that means 60% of active funds underperformed the S&P 500. I think last week, or maybe it was in our trading room with Finom group members, somebody asked me, you know, are we going to be range bound? How much longer are we going to be range bound? And as I always say, if I had a crystal ball, I wouldn't be doing a state of the market. I'd be retired on a beach in Tahiti, sipping margaritas with my wife, watching the kids and the, playing the sand and everything. Now I'd probably be doing this anyway because I'm passionate about it and I want to see people do well. But you get my point. I don't have a crystal ball, so I can't answer that with anything more than a guesstimate. But what this chart and data from, I want to say it's the Wall Street Journal shows. Oh, it's Bloomberg. I apologize. The S&P 500 sometimes gets stuck in a big range, and we've been in a range now for 11 months. The current 11-month trading range, it goes back to May of last year. Oh, I know we've made lower lows, and I know that we've had a peak of about 4,300 before the Jackson Hole, sledgehammer came out, right? So it's a wide trading range, but it's a trading range nonetheless, and it's 11 months old now that we haven't broken out or broken down. The sideways trading range, however, can presage big turning points at the end of years, long bull or bear markets. But it can also mark periods when the prevailing trends take a breather only to get right back on track. I mean, we were in an uptrend until 2022. There's the potential for us to get right back on track. And if there's something that could get us back on track and kind of fade the noise of the day to the background, it's probably this upcoming earnings season. And I get it. People are, oh, it's got, all you hear from CNBC is it's bad, it's going to be worse, and companies are going to cut, blah, blah. How come we've had no earnings surprise releases ahead of this quarter, this earnings season? Right? We've had those pretty much every quarter since Q2 of last year. So Q2, Q3, and Q4. We had handfuls, scoops, shovelfuls of, warnings ahead of earnings season. We've had none going into this earnings season. And I'm speaking to the heart of earnings season when the banks start to report. Next week, I think it's Thursday or Friday, JP Morgan, Wells Fargo, and Bank of America all on the same day. So that hasn't happened, even though the folks on CNBC and Bloomberg keep beating the same drum from Q4 earnings season and Q3 earnings season and Q2 earnings season. So we'll see. But if there is anything that could provide a catalyst to get us out of this trading range, as I've said before, we got to get above 4,200. That seems to have been the more recent line in the sand. Got to get above 4,200. If we do, there's probably going to be chase for performance again. Takes us to 4,300 and possibly even better. My 2 cents. This was a great chart from Warren Pye's friend of mine, great analyst at 314 Research. Because what have we seen in yields the last few weeks? 3-4 weeks, I guess you could say, is down, down, down. We've broken support levels pretty much across the Treasury yield curve. The 2-year Treasury yield, which is the most closely associated, tracks the federal funds rate, now has a negative. It's I guess that's 100 points. It's 100 points less than the federal funds rate. I think it's trading around 3.75%, the 2-year yield. But the federal funds rate is 4.75%. And when this has happened historically, as Warren Pye shows, back here, you had the savings and loan crisis. Well, you had the flash crash, Black Monday in 1987. Here, the 1990 recession. The long-term capital management issues in 1998. Also, the Russian ruble collapse. The tech bubble, 2000. Then we had the recession in 2001. 2008 great financial crisis. Of course, he's calling it a repo crisis of 2018, but I wouldn't. I think that was just, again, a consolidation year after 2 strong years, 2016 and 2017. COVID is not really, you can't say that's because of, one thing is because of the other. But now we have another occurrence where we're 100 basis points spread between the 2-year yield and the federal funds rate. Like the bond market, and you've heard this before hyperbolically, I'm sure, the bond market is screaming at the Fed to stop. That's kind of what this chart is showing. The bond market is telling the Fed, you're done. You guys, you're done. You don't have to do anymore. Inflation has been coming down for 10 months, likely 11 months. Like, you gotta stop already before something else breaks. Recessions caused by this? Not really. This is not a one-to-one correlation, right? We've been down here before. There was no recession in 1987. 1990, we had a recession, but the actual inversion down here was, it looks like 1989. Long-term capital management was kind of a, banking crisis issue, but no recession. 2018, no recession. 2019, no recession. COVID was not caused by this, inversion, if you will. So we've had 1, 2, 3, 4, 5, 6, now a 7th occurrence, 4 recessions. So what's that? 65% probability. It's a coin flip, if you ask me. Too close to a coin flip. And the other thing we've often talked about is because this chart is being fashioned in a manner that suggests it holds a higher probability of finding a recession here in the U.S. economy near term. And that might be the case. This isn't going to cause it, don't get me wrong, but it'll be symptomatic. I don't know that that's not priced into the market. I don't know that all the Fed hikes and now yields falling because they're worried about the Fed having gone too far and about to cause a recession. I don't know that that wasn't priced in last year. This chart goes back to last year. All the rate hikes, all the rate hikes. This is the yield curve, the 10-year minus the 3-month yield curve. And this is the S&P 500 index to 100 over a 12-month period. This is the worst performance in history for the S&P 500 based on the path of the 10-year minus the 3-month yield curve. Tell me this wasn't priced in last year. If it's the worst we've ever seen. The other thing, we know that there's never been a 25% correction in the S&P 500 without a recession. The worst was the 1962 22% drawdown. This one was 25%. You know, when people say, well, we're going to have a recession, I don't know that that's not what the market has already priced in 2022 to date. 22% correction, bear market in 1966 led to a 33% annual return in 1967. We had a 20% annual decline last year. We don't know what it'll lead to by the end of this year. But with respect to a potential recession, I don't know that it's already priced in. And if it's soft, if it's a short and shallow one, forget it, folks. Isn't that what all this corporate deleveraging has been about? All of these layoffs in the tech sector in Silicon Valley over the last 6 months, even into this year with Amazon announcements more recently and Walmart announcements at its fulfillment centers more recently. I mean, corporate America has already kind of prepared for a potential recession. And the market has already prepared for that, it seems like, as well. These are kind of the puzzle pieces put together. Never in history has the S&P 500 fallen 25% with the unemployment rate less than 4%. And that's what this chart shows. Usually, these big declines in the S&P 500, big declines in the S&P 500, big decline, big, they correlate with an above 4%. Here's the percent. This is 5% unemployment. Every time we get these big corrections, you get unemployment 5% or better. So we've never had a 25% bear market in the S&P 500 with unemployment 4% or less. So if we do get to 4% or even 5%, God, hope not, but if we do, haven't we already priced that kind of recessionary labor market last year? To me, it makes sense. To me, it makes sense. And maybe that's why we're still range bound. Maybe that's why the market is still so range bound. We haven't broken out, but we haven't broken down. Maybe we're just not going to break out or break down because we have these concerning issues. And until, we have something that is more decisive in the earnings outlook, we're probably still going to remain range bound. All right, analyst notes I want to get to. I'm going to try and go through them quickly here. This one, the Fed indicated no intention. This is Marko Kolanovic of JP Morgan. We expect a reversal in risk sentiment and the market retesting last year's low over the coming months. He also says Flows into risk assets last couple of weeks makes little sense against a backdrop of higher for longer rates. Markets still likely to retest lows in the months ahead. However, we do favor tech in the current environment. I think Marko Kolanovic is recognizing Amazon has already deleveraged. Who else? Oh gosh, Microsoft, Adobe, they've all deleveraged, and we got this whole, AI thing that is giving a boost to semis and a need. Everybody wants to get out in front of this. Nobody wants to be left in the dust when it comes to AI going forward. So you have that aspect of the technology sector, in overdrive. And I think Marko Kolanovic is looking at those variables and saying, if it's just a short and shallow recession, I probably still want to be in growth, which is tech. Oppenheimer's analyst, in our view, resilience is likely to remain the operative word as central bankers, regulators, businesses, and consumers navigate the economic landscape and markets look to climb the proverbial wall of worry. This is from Morgan Stanley, Mike Wilson. We view the tech sector's recent relative outperformance as a byproduct of several factors. Repositioning out of traditional cyclicals post the banking sector's events, a growing view that the sector is a defensive as traditional defensives, optimism that the recent expansion of the Fed's balance sheet to support the banking system is risk asset positive via the liquidity channel, and hope that the rate cuts the bond market is pricing come without a meaningful deceleration in growth. But he thinks that this is a farce. Mike Wilson at Morgan Stanley thinks you get out of this, you take your profits, and if you want to be defensive, you got to be in healthcare, consumer staples, and utilities. So he's saying sell this rally in tech. We're going to make new lows in the not too distant future. Recall, his low, he actually forecasted retesting the lows by April of 2023. Here's April, folks. 4,100, 3,500's way down there. He's got a long way to go, and he's only got 3 more weeks to make it happen. But either way, what we see with Mike Wilson is the same old, same old. He's a perma bear. It's eventual. For him, it's eventuality. Now, this is from Deutsche Bank, and their analyst, Binky Chadha. I know everybody knows Binky. They love his name. He's on Bloomberg a lot. And what he says is no. He disagrees wholeheartedly with Morgan Stanley's Mike Wilson. He thinks tech-related stocks have rebounded after a brutal 2023 that saw them bear the brunt of a broad market sell-off. So far, the rally has largely reflected an unwinding of underweight positioning, wrote Binky Chadha of Deutsche Bank. We see the next leg being driven by earnings beats and rising forward estimates, on which there has been little focus so far. Now, we focus on that, of course, but not so much, the rest of the market. So Deutsche Bank is taking a different position. They think tech is going to continue. Large mega cap growth is going to continue, with this rebound. Now, this chart here comes from New Edge Wealth. He's, the analyst there is Cameron Dawson. She's the one that's always on CNBC, Brad. A real pretty lady, very smart, very talented. I have found myself doing nothing but disagreeing with her. See what I did there? I led with niceties, and now I'm saying I completely see what I did there. It's balanced, right? It's balanced. Because she's basically said, sit on your hands. Like when these people, they're on air, all the time, week after week, and they just say the same thing, cautious. We want to see. I'm not in the business of waiting and seeing. And that's not me being undisciplined. It's the fact that I've already got a game plan. My game plan and my outlook for the year, coalesce around buying dips in these areas of the market. while other people are sitting on their hands doing nothing, not dollar cost averaging, improving their dollar cost average through trading around cores. No, I'm busy. We're busy at Finom Group, but a lot of these folks, including Cameron Dawson, basically say defense, 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 value, 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 none of which has worked into this year. Did it work last year? To a limited degree. I mean, defense, let's talk about the consumer staples last year. What were they up? 1-2%? I'd rather take a double-digit drawdown than a measly 1 or 2% in consumer staples. That doesn't do it. I can do better by compounding my positioning in the growth areas of the market going forward into the future than try to mess around by getting more defensive. So this chart right here, tech PE now above the pre-pandemic crisis. So here's the PE on the tech sector right now, pre-pandemic right there. So we are above the 2019 level. On an absolute basis, tech's blended forward PE 25 is above the pre-pandemic peak in early 2020. Valuation is not a catalyst in the short term, but 2022's tech underperformance is a great reminder that valuation can be a risk in and of itself. This chart right here, this is interesting because it shows tech has been defensive in the last 2 recessions. 2007 to 2009, 2019 to 2020. Here's the earnings per share change in information technology. Why do people go to tech? Because it has the best earnings contribution and generally the best earnings growth over time. And even when we're in recessions, information technology tends to have a better earnings per share than most any other area of the market. Here in the great financial crisis, information technology EPS for the year was only down 1% from 2007 to 2009. The only 3 areas that were better: consumer staples, healthcare, and utilities. So people are doing what is consistent with fears of a recession. Last but not least, this chart right here shows nobody's buying. When S&P 500 technology sector and the 3-month rolling fund flows into the largest tech ETFs. Nope. Now we know the insiders have been buying tech, but most of the fund flows, most people are not. That's why they're underweight tech. And that's why we kind of have the chase for performance into the end of the quarter. She says in her actual report, Cameron Dawson of New Edge Wealth, sell technology. This chart right here from Sentiment Trader, this is the top. S&P 500 information technology strategy just broke out. And that's the other thing, right? Technicals versus fundamentals, because most of this is fundamentals. Earnings, PE ratios, right? That's fundamental stuff. The technicals are screaming something different. And Sentiment Trader says this breakout and this number of 6-month relative highs in the last 15 sessions, I mean, that was serious. Relative to the S&P 500, the outperformance in tech, we've shown this in a different chart through rate of change, the outperformance between tech and the S&P 500. This is just another way of showing it. But when this happens, past breakouts, XLK was higher 91% of the time over the next 6 months and still outperformed the S&P 500 over the same period. But Cameron Dawson is saying sell technology. Fundamentally, the charts and the outperformance in tech based on Sentiment Trader's long history of data says to stick with it. I say think long term. If you own tech, if you like tech, stick with it long term. It generally outperforms. This just happened in the NASDAQ Composite Index. 2 series moving averages. The 1 month close is above the 1 year. So the 1 month moving average and the 1 year moving average, the 1 month closes above the 1 year moving average after being below it for 6 months. That's the chart up there. So when that happens, it's happened 1, 2, 3, 4, 5, 6, 7. This is the 8th occurrence. 1 month later, 6 times, NASDAQ was still positive. 1 time, it wasn't. 6 to 1, 3 months later, 6 to 1, 6 months later, it has never been lower a year later. Looks pretty good to me, NASDAQ. eToro does a survey every quarter. They survey 10,000 clients about what they're thinking and doing with regards to their portfolios and how they feel about the economy going forward. This is from Kaylee Boast of eToro. And their biggest concern is recession. That's their biggest concern. Rising inflation, that chart right there. But 21% of retail investors, 21% said a potential U.S. recession was the biggest external risk to their portfolio over the next 12 months. Everybody's been of this mindset, Brad, that I've talked to lately. The Fed is going to push us into a recession. The Fed, the last Fed hike, they keep saying that, well, when the Fed stops hiking rates, it's not a good thing. And I think what people are misinterpreting is when the Fed is cutting rates, it's usually not a good thing, because usually the Fed's cutting rates because something bad is happening in the economy. And usually that's being reflected by the market. But when the Fed cuts, when the Fed just stops hiking rates, typically it's a good thing. We know that the market typically does well. And also, what this chart shows, this is more about the S&P 500, but only one time, going back to the 1994 rate hiking cycle. So we've had 6 rate hiking cycles since, 1984. When they've stopped, when they've paused, we still didn't have a recession within a year. We still didn't have a recession within a year. The only time that we did was this one right here, 2000 into 2001. They stopped raising rates, and by 2001, we were in a recession. But it was only that one time. The Fed is not trying to push us into a recession, and rarely does that happen. Also, when at the last rate hike, so the end of a rate hike cycle, which started in 1994, this data from Data Track goes back to 1994, all the rate hike cycles since then. 1 month later, the S&P was up 3.6%. 3 months later, 9%. 1 year later, the market was up 35%. The 1999 rate hiking cycle, 1 year later, down 14%. But look, 2004 to 2006, all positive. 2015 to 2018, all positive. The average, once they've stopped the last rate hike, the average 1 month return, 3.3%, 3 months, 8%, 1 year later, 17%. Fed's not the enemy. Usually we are our own worst enemy. Because and what this also shows is that most people were not buying. They were not treating the Fed like their friend. Because when the Fed was hiking and the market was down, you said, don't fight the Fed, don't fight the Fed, which generally means sit on your hands until this all goes away. And then when the Fed stops, all this money comes into the market chasing after each other. And hence you get these very strong performance rates here. That's why I say there's no real such thing as don't fight the Fed. It's a matter of the Fed is actually your friend. They're helping you to achieve good value in the market. Apple went from 180 to 130 during the Fed rate hiking cycle. It's back up to 165. The Fed was trying its best to get you to buy Apple at a discount. I'm just using that one stock. It sounds facetious, but it highlights my broader point. The Fed is never your enemy. You're never really fighting the Fed if you see them as your friend in battle, against higher prices by giving you better prices. What are the probabilities of a recession this year? Well, I know if you look at this, that, and the other, everybody says the probabilities are real high. But the number of recessions starting in the year of the presidential cycle, year one, we've had a lot of recessions start. Year two, only one. But year three, a recession has never started in year three of a 4-year presidential cycle, folks. Every month we get the Philadelphia Fed Coincident State Index, which measures each state's GDP level. And they color code it. Anything, that here's unchanged. Anything up here is negative. Negative GDP, negative GDP, negative. Do you see any of these shaded colors up here, folks? Now, this is the February. We'll get the March at the end of April. It's 1 year, it's 1 month lag, right? Every single state in February, every single state had GDP expansion. Every single one. Here's the other thing you don't see during recessions, and that's double-digit growth in heavyweight trucks or heavy-duty truck sales. They were up double digits, 14.4% in February. You don't see this in recessions, folks. We've been keeping track of the high-frequency data so far as retail consumer spending. And this is from the Bureau of Economic Analysis. So it's federal data. And this here is the month of March. This is credit card. Well, this is payment card data, any kind of payment cards that are used. The U.S. Bureau of Economic Analysis can track. And as you can see, we've held pretty well. This is the update. This was last week, folks. And we've curled up. But more importantly, this is the Q1 period of 2023, including all of March when the whole banking crisis stuff started in the headlines. This is Q4 of last year. We actually this year have a higher median than the holiday period, the holidays of last year. So, we're looking for the consumer's 3/4 of the economy. We're looking for cracks in consumer spending and retail sales. Thus far, they're not really showing up. Is it slowing? Yes. Admittedly, consumer spending should slow. Retail sales should slow. The comparisons were so high last year that you get this natural rate of change, and you're not going to grow double-digit consumption year after year. I mean, the laws of large numbers are going to, eat into performance in the out years. But here's the Johnson Redbook retail sales. We finished the month of March with a bang. This was the final week. These are year-over-year retail sales as tracked by Redbook. It comes out every single week. We finished that on a high note. Are we slowing versus last year? Absolutely. But again, higher comps last year. In March of last year, we were growing retail sales double digits. We're just not going to do that on a year-over-year basis, folks. So do keep that in mind. The J.P. Morgan Jamie Dimon newsletter was out this week, and he says, this is an excerpt from the annual letter to shareholders. However, it is unclear whether the disruption is likely to slow consumer spending. As of April 1, 2023, spending has been consistently running higher versus the prior year. Although higher rates, particularly in mortgages, have reduced both home sales and prices, do remember that consumer spending drives more than 65% of the U.S. economy. That's Jamie Dimon in the annual letter to shareholders. I spoke about ISM manufacturing earlier, and the fact that it's in contraction territory. It's been in contraction territory since November of last year. 6 months, folks. Still not a recession. We still don't have a recession, even though manufacturing might be in its own recession. But did you know that the S&P 500 performance, when the ISM manufacturing is at 45 to 50, if it's in this range, the average return next 12 months, 10%. Prior 12 months has been 9%. That's averages, folks. So just keep that in mind. And this is Ed Yardeni's take on the most recent ISM manufacturing data, which stunk. On Monday, we learned that the manufacturing data was down to 46.3, the lowest reading since May of 2020. Sounds bad, right? That's somewhat unsettling because the yearly percent change in the S&P 500 is correlated with it. Then again, the yearly percent change in the S&P 500 might have troughed recently, suggesting that the worst in the manufacturing may be over as of this month. They've converged. Like the S&P 500 is the dark line here. This one, I don't know the color. Sorry, folks. the darker line here, that had troughed long before, manufacturing had reached this level, and now they're converging. Hopefully, we do get a tick up, a sustainable move up in manufacturing going forward. We're seeing that in Europe. We're seeing it in China. I think it's a matter of time before we are in that same boat. And that's all I've got. You got anything else for us, Brad?
Only to reiterate that what we said in January about the coming year has just played out almost perfectly.
Yep.
We've had fits and starts, and I keep insisting that if you'll stick to your game plan, you can make money with these up and down markets.
Absolutely. Yeah.
I don't think it's going to happen, but if we stayed in this range the whole 12 months, that would be rather unprecedented.
Imagine if we did, though, how much dollar cost averaging you could do. How many times have we traded PayPal? What, 62, I think. And I think our cost average on that now is around $45. The stock is $75.
If we do for the next 3 quarters what I did in my account for the first quarter, I'd be up almost 60% for the year in a sideways market.
Yeah, and not to brag, and that's fantastic. Coming into the Q2 period, year to date, I'm up 20%. Now, one of the things that we had talked about last year in July, we did a roadmap, of where we would allocate additional capital based on certain levels that are correlated with average bear markets and average bear markets in a recession. And one of those levels was 3,500, and we got there. So we allocated more capital. And the reason why we did that roadmap, and we also did this exercise about dollar cost averaging. So if it got to 3,400, we were going to add another 3%, exposure to the market. We were going to gain 3% exposure to the market. If it went down to 3,200, 3,258, I remember, that was going to be the final tranche. So we would have, in total, 3,500, 3,400, and 3,258. We would have done 3.3% for a total exposure, if all of those levels were met, right. Additional 10% exposure to the market, or 9.9%, rounded up to 10%. But the point of that whole exercise was to demonstrate that the market may not get back to its all-time high. But if you added 10% market exposure, just the S&P 500, the SPDR ETF, if the market rallied 42%, which would have not gotten it back to its all-time high, your portfolio, if it was equally weighted, would have gotten back to even at, back in July, if you were down the same amount of the S&P 500. Right. And that's the whole point of buying the dip. If you got cash on the sidelines, it doesn't matter if the market gets to all-time highs. Your portfolio is not the market. But if you use cash to dollar cost average, you don't need the market to get back to the all-time highs. In fact, there's a 10% differential. The market could be within 10% of its all-time high, and you would have been, based on the exercise that we outlined in July in our weekend research report, you would have been back to even. No harm, no foul. So, and I'm not saying I hope we have a range-bound market. I'd like to see just optimism, you know. It's people get stuck in this rut. It becomes disconcerting. They lose faith in investing. They get weeded out of the market. So from that standpoint, you know, I'd like to see a breakout. I'd like to see people with, you know, more optimism, belief in the market that they can do this. So we'll see what happens. We got to get above 4,200. That's the objective first, and then, you know, we'll take it from there. So just want to leave everybody with a happy holidays. Enjoy your day off from the market as well. As always, Brad, thank you for your participation here in the State of the Market.
We'll see you.